Regular viewers know we're not big fans of forecasting. However, when you review these charts, I think you'll agree that the stock market could surprise on the upside looking out weeks and months. We have a lot to cover. We won't spend a lot of time here. In this week's video, we'll review consolidation and breakouts and why it's relevant to the present day market using present day charts. Same thing with fractals. What are they saying now and how is it relevant to the present day? We'll review a chart pattern in high beta versus the S&P 500 and review the possible probabilistic significance. We'll look at numerous charts relatively quickly comparing bonds to current areas of strength around the globe, including countries, sectors, regions of the globe, etc. Some places on the web where you can find some other charts and additional resources. As we head into next week, some possible scenarios. We do have overhead resistance in a rising trend channel. If I had to put odds on it, and I don't manage based upon anything that we'll say here, we manage based upon what actually happens. I'd say the highest probability scenario is that we break out of that trend channel and push through it. Second highest probability, we bounce back off of the rising trend channel and then we move significantly higher. The lowest probability event, and the probability is far from zero, is that we morph into a 1987-like event that's very painful for investors. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll get to the charts here momentarily. Before we do, there's an article or a post on Short Takes dated October 18th. Tired of missing rallies? 4 ways to improve your game. You can find it by Googling Short Takes Shavako. The concepts: think in probabilities, develop an if-then system. In our case, that's our market model. Monitor the big picture and remain highly flexible. We'll incorporate these concepts into today's video. This is a weekly chart of the S&P 500 index. This is 2010. This is 2013. We'll use a loose concept of a base. Here's what we're doing here. We're looking at markets that make no progress over time. This is 1, 2, 3, 4 months. The market traded here, and 4 months later it traded at the exact same spot. That's an indecisive consolidating market. The point of the exercise is if you draw a box, in this case is a little easier. Let's use this one. If we go point to point, and we draw a box, the highest high and the lowest low between the orange line and the point to point, typically when you break out of that box, good things happen or bad things happen. And all these cases are the same. Multi-month consolidation, point to point, here's a high, here's a low. When you break out of the box, in this case, bad things happened. We moved all the way down to here. Here happened in 2 areas, so we almost have a double box. Point to point, the market's at the exact same spot here and here. When you break out of the box, good things happen in this case. In the present day, we have made very little progress for several months here. The market traded in the 1650 1660 range several months ago, back in early May, so that's 1, 2, 3, 4, 5 months ago. And we hit the exact same spot intra-week last week. It appears as if we are now breaking out of that box. we're above this highest high here. The box again is defined by the lowest low and the highest high between the point to point. It appears as if we're breaking out in a bullish manner. This breakout here, probabilistically, is similar to this breakout here. This is on a weekly chart. We can take this concept to all different time frames, including a 60-minute chart, which we'll look at next. Before we move ahead, we'll be zooming in on a box like this conceptually on a 60-minute chart, so we won't show this piece or this piece. We'll focus on the core. The concept of fractals is what tells us that we can take these concepts from a weekly chart to a daily chart to a 60-minute chart all the way out to a 1-minute chart. And those of you that trade or look at different time frames, you know that the market works in similar ways or exactly the same in all time frames. You can use RSI on a 1-minute chart, and you can use RSI on a monthly chart. So here we're looking at a 60-minute take of one of these boxes. It's exactly what we looked at before. This is a 16-day period here. This is day 17. We have a point-to-point basing or consolidation. Point A right here in day 3 is exactly the same as point B in day 16. So this market went nowhere from basically day 3 or 4 out to day 16. The way we draw our box, we go point to point, and then we take the highest high between the 2 points and the lowest low. So we get this big box here. We also have from A2 to B, point to point. So we go from basically here, this box at the top, to here, and we do the same thing. This is the highest point between A2 and B, and this is the lowest point. So now we have 2 consolidation boxes on this chart, and in this case, we have a bullish breakout to the upside. So before we move on here, I think we'd all be in agreement that this looks bullish here, and this is a consolidation here, and we have a breakout from a 16-day, or really it's a 13-day consolidation because it starts here. Day 4 to day 16 roughly is where our consolidation takes place. Now let's move the same concept to a weekly chart and tie it into the present day. We're basically looking at the same chart for educational purposes. I told a little white lie. That wasn't a 60-minute chart. It was this chart here. But fractals tell us that whatever applies to a 60-minute chart from a pattern perspective applies to a weekly chart. This is the S&P 500. This is 1997 here. So instead of having a 16-hour period that we're looking at, we have a 16-year period that we're looking at. And everything that applied to the 60-minute chart applies to this chart, including this move here isn't necessarily a bubble. Point of the exercise, long base. This is a 13-year base here, sideways movement. The market went nowhere from here to here, and now we have a bullish breakout. What does it tell us? It tells us from a probabilistic perspective that the market may shock on the upside in the next few weeks, months, or years. Probability and flexibility are big. Those of you that have watched these videos for years know we absolutely positively hate forecasting. Why? It brings bias, which is covered in that Short Takes article. We also have to be flexible, and we also know that failed breakouts can be disastrous. So if the stock market comes back down in this direction, which is quite possible, anything's possible, we have to keep an open and flexible mind. But if we move back into the area below 1600, we could see something like this again. Again, failed breakouts on any time frame. A 1-minute chart, a 60-minute chart, a daily chart, a weekly chart. A failed breakout is not a good thing. Right now, we almost have the opposite. This is a retest here. If I extend this box, we broke out. We retested this, what once was resistance here in the year 2000, here in the year 2007, may act as support. And that's exactly what it did in 2013. Previous resistance acted as support. Those of you that follow along on Twitter at Shevako Capital know we tweeted this chart either Thursday or Friday. You don't need to know anything about Twitter to read our comments. You don't need to be on Twitter to read our comments or use the links to see charts like this. Just Google at Shevako Capital or Shevako Twitter, and you can go to the page like any other page and use the links. You don't have to sign in, establish an account, or anything. You can monitor people for the sake of monitoring only. Concepts here. We hear or see a lot the term bubble. This does, in isolation, look bubblish. However, the stock market has gone nowhere in 13 years. In fact, I think you can make an argument that this is not a bubble. This is a massively underperforming stock market from historical standards. It's not very often that you have periods where the stock market goes absolutely positively nowhere for 13 years. Again here, absolutely positively nowhere for 6 years. To put the bubble in potential perspective, and there's no question that we could come back down in this direction and turn into this. We're open to that scenario and by no means have closed it out. We need to see observable evidence. If something like this or something like 1987 takes place, observable changes and evidence will take place as the market rolls over. As the market rolls over here. Again, to put the bubble in perspective, in 2013, we're 10% above a high that was made 6 years ago. That does not sound like a bubble. That's not even a 2% increase per year. We're 12% above a high that was made 13 years ago. If the stock market went up 12% in 1 year, you wouldn't say that that's a bubble. Well, the stock market just went up 12% in 13 years. So when you look at fractals, bubble doesn't really apply here. If anything, we have a long-term base and we have a bullish breakout. This is not a forecast. It's just a way to say keep an open mind about the stock market shocking on the upside in the next few weeks, months, or years. We don't need to know what will happen, but it does help. How does it help? It helps because if you understand this, A, you might decide to get invested. B, you might err on the side of holding your positions since there's a chance that we'll have volatility, but the bias will be up. Here's another chart that I would term as an anecdotal piece of evidence. All the charts that we've covered up to this point are anecdotal pieces of evidence. How do we incorporate them in the market model? We don't. We don't use any of this in the market model. Why? Because if you have a breakout like this, let's look at this as potential resistance here. How would I use this potential resistance in the market model? I don't. Why don't I? First of all, drawing this line is subjective. It's not binary. I can't answer it with a 0 or 1. But most importantly, if this acts as resistance, let's assume we're looking at the S&P 500 and this line acts as resistance, well, then certain things have to happen. Price has to come up here and bounce off and move in this direction. And when it starts to do that, observable changes will take place that will be picked up by the market model. So I don't need to guess in advance or know in advance what will happen at a line like this. I just need to pay attention with an open mind. If I guess here, and my guess is that this will act as resistance, and I'm wrong, well, now I'm in a tough spot. From our perspective and our time frames and based upon our methodologies, which by no means, there's a million different ways to skin a cat in the stock market. We do it from one perspective. There are a lot of different ways to do it, and I encourage you to find a way that makes sense to you and build your own models. If you build your own models, the probability of staying with it is much, much, much higher. Point of looking at this, high beta stocks, we've got what's known as an inverse or inverted head and shoulders pattern, left shoulder, head, right shoulder. This can be a bullish pattern. Point of the exercise, if this is indeed a bullish pattern, and this is unquestionably a bullish breakout here that took place in July of this year, we broke a downward sloping trend line here. That's step one of a trend change. We made a higher low. That's step two. We recently made a higher high. That's step three. And now we have an established uptrend, which is a series of higher lows and higher highs. Well, if high beta stocks relative to the S&P 500 are in an uptrend, that doesn't look like a bear market. That doesn't look like a market that's concerned. In fact, 2011, the stock market tanked right here in August. It dropped like a waterfall. Well, prior to the waterfall drop, look at this ratio. It was in a downtrend, price below blue, blue below red, slopes of both down. That's a bearish look that foreshadowed that waterfall decline. The present day looks nothing like that. We have a bullish look that looks more like when we came off the low in 2012. Price above blue and red, blue above red, slopes of both up. That's a bullish look. This looks bullish. This may act as resistance. It appears as if we have a bullish breakout, but that assumes this trend line's drawn properly. That's a manually drawn trend line. We're basically saying this area is potential resistance. Right now, this seems to align with the bullish case, and this looks like a bullish breakout, but we'll keep an open mind as always. This is a weekly chart that helps us answer the question, would I rather be in bonds, TLT, or would I rather be in emerging markets, EEM? We're looking at the ratio of TLT, long-term treasuries, relative to the emerging markets ETF. The concept of trend following and using moving average crossovers is fairly simple. You're trying to discern between volatility to ignore and volatility to respect. What do I mean by that? We get a bullish moving average crossover here. This is volatility to ignore. We never get a bearish moving average crossover. Never get a bearish moving average crossover. Eventually we get it here. Volatility to respect before this big decline in the ratio. Bullish moving average crossover, gains. Why are we looking at TLT relative to EEM? Am I picking on TLT? No, to the contrary. TLT has shown some signs of life, and there are reasons to believe that TLT may continue to do well. It did well last week. TLT was not a bad place to be. It wasn't the best place to be, but it wasn't a bad place to be. On our scoring systems, TLT is right on the cusp of hitting the we're allowed to buy it level. So, from a opportunity cost perspective, we should compare TLT to other alternatives. And what the present day look of this chart as of the close on the 18th says is, I'd rather be in emerging markets. Why? When this ratio trends down as it is presently, it tells us that there's a bearish trend in place for treasuries relative to emerging markets. How does that happen in the economic and real world? It tells us that the conviction to buy TLT is weaker than the conviction to buy emerging markets. Here, that flips over. Here, the conviction to own and the confidence in TLT is greater than the conviction or confidence in EEM. Now let's flip through 9 other opportunity cost analysis charts and see how TLT stacks up presently. Doesn't mean that TLT can't turn starting next week and morph into something like this. If it does, we're happy to take a look at it, we're happy to own it, and we're happy to put all bullish probabilistic outlooks in the trash can. Same exact concepts, same exact chart. We've just swapped out EEM with EFA. So this tells us that I'd rather be in foreign stocks relative to bonds. Also noteworthy, this ratio on this chart made a new lower low this week, which is important. If you're going to see a turn like this, at some point you have to make a higher low before you can flip from a bearish trend change to a bullish trend change. So what this tells us is probably at a minimum for us to get to this point, it's going to take some time because this ratio has some work to do. That process may begin next week. This chart here may morph into this, but we don't have any observable evidence to tell us that's the case. This chart here confirmed this week that being an EFA was a better place than TLT. Relative to FEZ, Europe also made a new weekly closing low, TLT relative to FEZ. This chart is bullish for FEZ relative to TLT. When we look at these weekly charts, up in the upper right-hand corner, it tells you the change for the week. So it says that QQQ was a much better place to be last week than TLT, new lower low. If you owned QQQ relative to your neighbor who owns TLT, you beat him by 2.1% last week. SPY, the S&P 500 ETF, still favored over TLT. SPY beat TLT by 0.9% last week. VEU gives us a broader brushstroke. This is global stocks, sans the United States. The answer is I'd rather be in VEU. It was confirmed with a new weekly closing low last week. VEU beat TLT by 0.7%. Song remains the same here. VT is basically VEU, but it includes exposure to the United States. About 48% of VT is inside U.S. borders, and about 52% of it invests in stocks outside the U.S. VT outperformed TLT by 0.7% last week, new weekly closing low. Taking a broader view of the United States, total stock market, VTI outperformed TLT last week by 1%. This still is, I'd rather be in VTI or stocks than TLT look. Flexible, open-minded. If it begins to morph into something like this, we're happy to make changes as the observable evidence changes. Another flavor, XLE, outperformed TLT by roughly 1.6% last week. This is a new weekly closing low, confirming the current downtrend that's in place, which favors XLE over TLT. Now we're looking at TLT relative to SH. Would I rather be in bonds or would I rather short stocks SH? This is an anecdotal piece of evidence, but interesting nonetheless. You can see there's a long-term trend here. No bearish moving average crossovers that favors bonds over shorting the market. Recently, with the taper scare, that changed for the first time in years. Now, fear has waned a little bit. The answer is I'd rather be in TLT over SH. We get the bullish moving average crossover, blue above red, slopes turn up, price above both. Again, anecdotally, the last time that happened was in the spring of 2009. Here's the bullish moving average crossover, blue above red, price above both, slopes up. Stock market did very well after that. Again, it's an anecdotal piece of evidence. We're not going to do anything with this. This does look similar to this, which took place in the month of September and October, morphing from a bearish look to a bullish look. This is the master CSM market model spreadsheet that takes all of the binary answers and the mathematical inputs, unbiased information, a lot of programming done down here below. Ultimately, what it spits out is a recommended allocation. The purpose of the market model is not always to maximize returns. What we're looking for is risk-adjusted returns. We do want to maximize returns when conditions are favorable. You can get a visual here of how that works. As the stock market deteriorated during the debt ceiling scare, this is the end of September, the model had about a 62 to 69% exposure to stocks. This is cash in this case because we can't justify buying bonds yet by the rules, as we mentioned earlier, that may change soon. The model helped us reduce risk. This is the height of fear in here. The market was extremely vulnerable on Tuesday the 8th and Wednesday the 9th. We had basically a bearish stance. We had more cash than stocks, more cash than stocks. Why do we do that? If the market went in the other direction and we had some anomaly where we had a technical default and the market plunged for 2 or 3 weeks, we would have already reduced risk, suffered less because this cash buffer was there for us, and if we morphed into a bear market from there, where the recent highs wouldn't be revisited for 2 or 3 years, we could continue to scale out of stocks and scale into conservative assets like bonds. The market model is designed exactly for what happened last week, where we go from risk off to risk on like somebody flipped a light switch. So between Wednesday the 9th and the close on Friday, the market model allowed us to ratchet up quickly, and as of the close on Friday, this is our base exposure to the market. Clients gravitate a little bit above and a little bit below that based upon their situation and risk tolerance. Should the market deteriorate next week, there is some resistance overhead. Bonds, as we said, are showing some signs of life. We'll migrate back in this direction very quickly. We can move from this type of allocation to this type of allocation. How quickly you move in either direction is directly proportional to how quickly the market is deteriorating or how rapidly it's improving. We improved rapidly between the close on the 9th and the close on the 18th. Therefore, the model allows us to incrementally scale up rapidly. If you'd like to learn more about the concepts behind the market model and how we use it, go to our home page, click on Market Model here, or you can look at back-tested results here, and you can see inputs in the submodels here. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.